In today's M&A market, companies need to approach corporate development differently in order to increase their success. Today, we'll be discussing Crowe Horwath's new study, Steering Successful Growth, Value Capture in M&A. Joining me is Marc Shaffer, an M&A Transactions Advisory Partner at the firm. Welcome. Good to see you here.
Thanks for having me.
Now, one of the key findings in the survey, not all synergies are created equal. So how should companies approach synergies in strategic deals? What areas at this point are more challenging?
Yeah, I think we find, and really the survey kind of documented for us, that companies tend to make a laundry list of synergies and they put all the value of all those in their modeling, but that causes them, when it comes to the integration execution phase, to really chase too many things. And we have found, and I think those successful deal makers have said, that it's better to focus on just a few of the synergy opportunities. Those ones that are going to give the best return on investment, focus a real plan around those, kind of how, when, who's responsible. So who's responsible for delivering it, what are the activities that need to happen, and what's the timeline for delivering that. And by focusing on those few, you tend to get a better result versus spreading kind of too thin and chasing all the various synergies. As far as the second question, kind of what should they be focused on, what's more attainable, we find CEOs today don't let their corporate development teams put kind of revenue or top line type synergies into the modeling. They're looking more for the operational things, those things that can be controlled. On the revenue side, there's too many marketplace variables that cause the opportunity to achieve the synergy may cause that to not be achieved or more difficult to achieve, versus on the operational side, those things are in an environment that are internal, so those tend to get more credit from the CEOs, and that's where the corporate development people are going today.
I want to ask you about due diligence. It's not just about financials. Incorporating IT, operations, HR, culture were reported in 9 out of 10 successful deals, according to your survey. What's changing in due diligence at this point? What are deal makers doing differently to increase their success in these deals?
I think the focus of the due diligence has changed. In the old days, kind of the natural reaction was, let's get the due diligence started. We want to do financial diligence, legal diligence. Today, companies are looking more at, why am I doing the deal? What's the value drivers that causes the target company to create its unique market value? And why are we buying the company? What's the strategic fit? They then tend to identify, what's important about that company and structure the diligence around that. So it may be operational aspects are more important, or maybe it's a people business like an engineering company, and the diligence tends to be more focused in that area initially, and then the confirmatory things like the financial may come later. So it's a little bit of a switch in where the focus is. I also think that there's more thorough due diligence being done today with the high multiples that are being paid by people. There's so many studies out there, including ours from last year, that indicate that deals fail to achieve the strategic objective. Therefore, people are focusing more on doing deeper due diligence, more thorough across all the functional areas. So that's kind of been what the switch has been over maybe the last 3 or 4 years.
Another point in your survey that many experienced deal makers underestimate the value of integration. So what do you see in the market relating to the use of internal and external resources for integration and due diligence? And also, what incremental value should a company expect from the results of integration?
Yeah, so one of the surprising things that came out of our study is that in the due diligence area, companies tend to understand they need to do that today. As we just talked about, they're more thorough, tends to be used in most cases, whether it's even a successful or unsuccessful deal. The surprising factor was on the integration side, that there's a lot less focus on that. Tends to be maybe a job that somebody takes on as in addition to their day job. They don't hire experts to help them with it. So there's not the same level of focus on the integration as there is on the due diligence. And we find that normally if people are saying we did not achieve the value, it's not because they didn't properly identify the risks up front or do their due diligence. It's they didn't have the right plan in place and then execute on the plan if they did have one on the integration side. So we think the value of the integration is if you have a focused, experienced leader, be it internal or external, driving that integration process, only job that person has tends to be not the norm in what we see in the marketplace. But if you have somebody focused on that, you're going to achieve those synergies we talked about before. You'll be able to have an integration plan that'll move along quickly, we find that speed normally ends up with a better result in the marketplace. So what's the value you're looking for? That it's really achieving the strategic plan. Normally the strategic plan is good, and the reason for buying the business normally is a proper thing to do, but the failure ends up in the integration. So we counsel people to make sure you put as much effort towards the integration plan and execution as you do towards the due diligence side.
Another interesting finding had to do with cross-border transactions. Basically, they present far more challenges and risks than domestic deals. So do you find that companies are better focused on these cross-border transactions or the domestic transactions?
Again, probably the most surprising statistic out of our survey is that there's more focus on domestic deals. So I think the statistic is something like 11% of the successful deals were cross-border, and 33% of those deals that were deemed to be unsuccessful probably didn't achieve the strategic intent. Didn't mean it was a failure, but didn't achieve the intent. Those are on the cross-border side. So again, the disproportionate results and driven by the amount of effort that people put towards the cross-border deal. As you mentioned, you would think because of the differences in regulations, culture, risks, business practices, so forth, that you would put more of an effort towards the diligence and integration planning on a cross-border deal, and that's not what we're seeing people do in the marketplace. I can only presume that's because it's different. They don't know their own colleagues overseas. They don't have people they've worked with in the past overseas that they can work with, so they don't know how to attack it in the same way, and therefore they tend to just do less when they should be doing more on a cross-border deal.
Very interesting study. Marc, thanks so much for joining us.
Right. Again, thank you for having me.
Marc Shaffer is an M&A transactions advisory partner at Crowe Horwath. For The Deal, I'm Rhonda Schaffler.